Hey everyone, welcome back to Book Beer. I'm Paul.
And I'm Alice.
Today we're diving into a classic, a book that Warren Buffett himself called by far the best book on investing ever written.
High praise. That's got to pique anyone's interest. What are we tackling today?
We're taking on The Intelligent Investor by Benjamin Graham. Don't forget to like and subscribe to our channel. Also, let us know in the comments which book you'd like us to summarize next.
So what's the big idea behind this book?
In a nutshell, Graham wants to help us understand the difference between investing and speculating and how to be successful in the long run. He says a true investor doesn't just chase quick profits. They look at the real value of a company.
That makes sense, but the market can be pretty unpredictable, right?
Exactly, and that's where the idea of Mr. Market comes in. Imagine this guy comes to you every day offering to buy or sell stocks at different prices. Sometimes his prices are reasonable, other times they're driven by pure panic or hype. Graham says we shouldn't let Mr. Market's mood swings dictate our decisions.
So how do we avoid getting swept up in all that?
By staying disciplined and focusing on what a company is actually worth. Graham calls this value investing. It's all about digging deep into a company's financials, their position in the industry, and how well they're managed.
Sounds like homework. Any specific tips Graham offers for evaluating a stock?
Absolutely. He's all about checking out the company's financial statements, balance sheets, income statements, the works, and looking at their earnings power. Can they consistently make money?
Makes sense. Anything else?
Don't forget about dividends. A history of steady or growing dividends is a good sign that a company is reliable and cares about its shareholders.
Okay, so we find a solid company, but at what price do we buy?
That's where the margin of safety comes in. It's like a built-in buffer to protect your investment. You want to buy stocks significantly below their real value, just in case your analysis isn't perfect.
So even if things don't go exactly as planned, you're less likely to lose big.
You got it. Graham also talks about two types of investors: defensive and enterprising.
Tell me more.
Defensive investors want simplicity and safety. They might stick with index funds or big, well-known companies. Think a 50-50 split between stocks and bonds. On the other hand,
Enterprising investors are more hands-on.
you know it. They love digging into research and finding hidden gems in the market. They're willing to take on more risk for the chance of higher returns.
That's fascinating. So which type of investor is the intelligent investor for?
It's for everyone. Whether you're just starting out or a seasoned pro, there's wisdom in this book for all of us. Graham gives us the tools to think for ourselves, stay calm when markets get crazy, and ultimately make smarter decisions with our money.
This has been incredibly insightful. A lot to consider for anyone looking to become a smarter investor.
Definitely. Big thanks to Benjamin Graham for this timeless guide. Remember, knowledge is power. Don't forget to like this episode and subscribe to our channel.
Picking up where we left off, last time we were talking about, all the new investment options out there.
Index funds, ETFs, it can feel like a whole different world, right?
Yeah, since The Intelligent Investor was first published. But you know what? The underlying principles, the core ideas about smart investing haven't really changed.
Exactly. Graham's ideas about building a really rock-solid portfolio are still relevant, even if the tools, the actual tools and technologies have changed.
So let's get into that. Portfolio building. Where do we begin, according to Graham?
Well, first off, he stresses having a portfolio policy. It's like your game plan for investing.
A clear strategy. So we're not just reacting to every little market blip.
Exactly. And it's got to be a strategy that really fits you. Your risk tolerance, what you're aiming for, how long you're planning to invest.
So not one size fits all. We need to know what kind of investor we are, right?
Exactly. Remember those two investor personalities we talk about?
Yeah, defensive and enterprising.
Right. And that's going to influence big time how your portfolio looks.
So like a defensive investor, they might have more of their investments in bonds because they're generally, less risky than stocks.
Exactly. And the enterprising investor, they might lean more towards stocks, trying to get those higher returns.
Makes sense. But Graham doesn't want us going all in on one thing, right? He was all about spreading the risk.
Absolutely. Diversification, spreading those investments across different types of assets.
Industries, even different countries.
Exactly. Don't put all your eggs in one basket, right?
Okay, so we've got our different asset classes, but how do we actually choose what to invest in?
Well, Grant has specific things he looks for in both stocks and bonds. And he always stresses doing your research.
Right, understanding the businesses you're putting your money into.
Yeah, not just like picking whatever's hot or trending.
So even within our stocks, say, we're not just randomly picking, we're doing our homework, right?
Right. Back to those financial statements. Evaluated the management team, margin of safety, all that good stuff.
Okay, so this is pretty intense. Do you actually need a finance degree to do all this? Can a regular person handle this?
Absolutely. Graham wrote this book for everyday people who want to be in control of their finances, their future.
He makes it pretty clear, actually. provides that practical guidance.
And there are so many resources out there now, websites, books. You can even get help from a financial advisor.
So even if you're not like a financial expert, you can still be a smart investor.
Exactly. By using Graham's principles and, doing your homework.
It's empower, being informed, making your own decisions, not just following the crowd or whatever the latest hot stock tip is.
Right. Okay, now that we've talked about portfolio construction and all that, there's another big thing Graham talks about that's really important.
What's that?
The psychology of investing. How our emotions, our feelings can really mess with our decisions.
Yeah, the human element, right? That's a big one. We all have emotions, and they can make us do irrational things even when we think we're being logical.
And Graham knew this. He has a whole chapter in the book dedicated to it.
Interesting. So what are some of the psychological traps we can fall into?
The biggest one is like getting caught up in market swings.
Yeah, the ups and downs, that volatility can be a roller coaster.
And it's so easy to, panic and sell everything when the market's down or go crazy buying when it's going up.
Like our instinct is just to follow the crowd, whether it's running from Ranger or chasing the shiny object.
Right. And Graham's whole thing is don't let emotions drive your decisions. He says successful investors, they can tune out that short-term noise. They focus on the long game.
Easier said than done, though. Right. It's like in our nature to react to those big market swings.
Totally. But he has some good advice for managing those emotions and making smarter choices.
Like what? How do we keep our cool?
Well, first, having that investment plan we talked about, like a roadmap.
So that's our anchor when things get choppy.
Exactly. When you have a plan, you're not as likely to just, react out of fear or get greedy.
Makes sense. What else helps?
Doing your research. Understanding the companies, the businesses you're actually investing in.
The more knowledge we have, the less likely we are to freak out, right?
Right. When you know what you own and why you own it, you're less likely to just sell everything when things get a little rough.
Right. Makes sense.
And finally, Graham talks about the importance of patience.
Patience.
Yeah, patience.
Why is patience so important when it comes to investing?
Because building wealth, real wealth, it takes time. It's not a get-rich-quick scheme. You need to be consistent, disciplined, and you got to think long-term.
It's like planting a garden, you can't rush it. You got to let things grow.
Exactly. And that can be tough in today's world. We want everything right now.
Instant gratification.
But when it comes to investing, slow and steady, that often wins the race.
You know what? If you guys are finding this interesting, hit that subscribe button and let us know down in the comments what's really standing out to you about the intelligent investor.
Okay, so before we finish up with Graham and all his wisdom, there are a couple more things we should touch on.
Okay, what else is there?
That margin of safety we mentioned earlier, that's a big one.
Yeah. That's buffer to protect us from surprises.
Exactly. It's the difference between what you pay for an investment and its intrinsic value.
What it's really worth, just down.
You got it. And Graham really believed that this margin of safety, this is key for reducing risk, for increasing our chances of winning in the long run.
Now, how do we actually figure out this margin of safety? That seems kind of tough to pinpoint.
It could be a bit of an art, not an exact science, that's for sure. But Graham gives us some tools, some techniques in the book for, trying to estimate that intrinsic value.
So back to analyzing those financial statements, earnings history, assets, all that.
Exactly. And once you have a good idea of that intrinsic value, you can compare it to what the market is saying, the market price, and then you can see your margin of safety.
The bigger that gap, the better, right?
Yeah, the bigger the difference, the bigger your margin of safety. And theoretically, the less risky the investment.
So we're looking for those bargains, those hidden gems that maybe the market's just totally missed.
Right. And that often takes a little bit of what Graham calls contrarian investing.
Contrarian investing? What's that all about?
Basically going against the crowd. Zigging when everyone else is zagging.
So buying what everyone else is selling.
Yeah, kind of. Graham felt like those situations, they often had the best deals for value investors.
But that takes some guts, right? Going against the flow can be intimidating.
For sure. It's not for everyone. But Graham believed that, truly intelligent investors, they can think for themselves.
Yeah, make their own decisions based on their analysis, even if it's not popular.
Exactly. He believed that the market sometimes, it overreacts to good news, bad news, and those overreactions, well, they create opportunities.
For the contrarians.
Exactly. He gives a lot of examples in the book, showing this happening throughout history.
So how do we actually put this contrarian thing into practice?
Well, you got to do your research. Find investments that you think are, underpriced by the market, companies that maybe had a recent setback, industries that are out of favor, even whole countries with, economic problems.
So we're looking for those situations where everyone's super pessimistic.
Yeah, but and this is important, not every out-of-favor investment is a good deal.
Right. There's a reason why some things are being sold off.
Exactly. So do your due diligence. Really analyze those fundamentals. Make sure you get the risks.
It sounds like contrarian investing is maybe not for beginner.
It can be tough, yeah, but not impossible. The key is to, start small. Do your research. Build your confidence over time.
And maybe start with just a little bit of your portfolio just to get your feet wet.
Right. And remember, Graham's big on having a long-term perspective.
So even if it doesn't do well right away, don't freak out. Give it time.
Exactly. The market, it doesn't always figure things out right away. Sometimes it takes years for a contrarian bet to pay off.
This has been really, really insightful.
Me too. Value investing, financial analysis, building our portfolio, psychology, contrarian thinking. We covered it all.
If you're feeling inspired, check out the book yourself, The Intelligent Investor. It's a classic for a reason. And hey, if you've enjoyed this, please hit that like button and subscribe to Book Peer for more deep dives into, all sorts of interesting books.
One of the things that really stands out is how relevant Graham's ideas still are, even though, well, the investing world has changed a lot since he wrote this.
Oh, absolutely. I mean, think about it. We have all these fancy new tools, algorithms, robo-advisors, you name it. But the core principles of sound investing, those haven't really gone out of style.
Right. And Graham really hit on some timeless wisdom, like that idea of margin of safety. It's almost like a common sense approach to protecting yourself.
Yeah, like that buffer, that cushion we were talking about earlier. You don't just jump into an investment. You make sure there's room for error, for the unexpected.
Exactly. And Graham was adamant that this margin of safety was absolutely key for minimizing risk, especially since, well, let's be honest, our analysis of a company isn't always going to be spot on.
True. And on top of that, the market itself can be, well, let's just say a bit unpredictable. Things change fast, and you need that cushion to weather the storms.
Exactly. So how do we actually figure out this margin of safety? I mean, it seems like it would be a bit subjective, right?
Yeah, it's not like there's a magic formula, a set of hard and fast rules. It's a bit of an art, but Graham does give us some really useful tools and techniques in the book to help us estimate a company's intrinsic value.
We're back to those financial statements again. Earnings, assets, liabilities, all that good stuff.
Right. And once we have a decent understanding of what that intrinsic value is, we can compare it to, what the market's currently saying the price is. That's how we can see our margin of safety.
And the bigger that gap, the better, right?
Exactly. The larger the difference between the intrinsic value and the market price, the larger that margin of safety, and, at least theoretically, the less risky the investment should be.
So we're essentially hunting for those hidden gems, those undervalued companies that maybe the market's just overlooking or mispricing.
Right. And, that kind of ties back to what we were talking about before, contrarian investing. Being willing to see value where others might not.
Yeah, zigging when everyone else is zagging. It takes a certain kind of confidence, that's for sure. But Graham believed that truly smart investors, they think for themselves.
Exactly. They make decisions based on their own analysis, even if it goes against what everyone else is saying or doing.
And that can be hard. There's a certain comfort in following the crowd. But Graham reminds us that the market doesn't always get it right. It can overreact, get swept up in emotions.
Oh, for sure. And those overreactions, they create opportunities for the people who can keep a cool head.
Exactly. And whether you're more of a defensive investor, playing it safe, or a more enterprising one, willing to take on some risk, the principles Graham lays out in The Intelligent Investor, they're like a roadmap.
Totally. A guide to help us navigate the often confusing world of investing.
And I think that's the beauty of this book. It empowers us, gives us the tools to think for ourselves, to avoid those emotional traps, and to really focus on building long-term wealth.
Well said. And if you've been enjoying our deep dive into The Intelligent Investor, we really encourage you to, grab a copy and explore it for yourself. There's so much wisdom packed in there.
And we'd love to hear your thoughts. What resonated with you? What are your biggest takeaways? Drop a comment below and let us know.
And if you're hungry for more conversations like this, make sure to hit that subscribe button and join us right here on Book Peer.
Thanks for joining us, everyone.